Hello everyone, welcome to my video. Thank you for taking the time out to click on it, and I hope that this video can answer your question on what makes up your credit score. I hope you get something out of it. I hope it's an educational experience, and I don't want to stall any further and take up too much of your time. I'm gonna try to keep this video short, maybe about 10-15 minutes tops. So let's get right into it. Oh, by the way, please don't forget to drop a comment, click that like, and subscribe to my channel. YouTube has an algorithm, and they like to see, when the viewers are engaging and interacting with the video that they're watching at the time. So please, you know, do me a favor, just give me a comment, hit that like and subscribe. It's totally free of charge, as you know, so it won't hurt at all. But yeah, just give me one of those if you can. All right. Thanks a lot. I appreciate it. And now back to our regularly scheduled video. Okay, first and foremost, the most important part of your credit score is based on your history of making payments. Believe it or not, this actually accounts for 35% of your overall credit score. What this means is, well, pay your bills on time every month, like clockwork. Um, we have technology nowadays where you can set up certain bills to come out of your account automatically, uh, auto pay. So, you know, utilize that. And when the money comes out of your account, I mean, after a while, you won't even miss it. You'll forget all about it. But the main thing is that you're not missing any payments. You're paying your bills on time. Or you can use your smartphones. A lot of these smartphones have a function called reminder, and you can use the reminders to every month. It'll just give you a notification of when bills come up, and you set it up like that, and you know you remind yourself to pay your bills. Uh, it's very important. You don't want to miss any payments. You want to be late on any payments. You definitely don't want to be late more than 30 days because it'll definitely show up on your credit report, and it'll knock you down some points. Trust me, you're not gonna like it. It's best if you could have a 100% payment history. I know 100% sounds almost impossible because we're all human beings. We're not perfect. We're bound to miss a payment here or there. But trust me, when it comes to these FICO scores and being late or missing payments, if you miss just one, like I said, you're going to feel it. You'll definitely see it. It will reflect in your credit score. So, in short, just make sure you do whatever you can to make sure that you're paying all your bills on time, all the time. Next up is the amount of credit that you use accounts for a lot of your score. It actually accounts for 30%. The total amount of your credit balance compared to the amount of your total credit limit is how you find out your credit utilization. You should aim to keep your balance of at least 30% or less to have the best effect on your credit score. What does that all mean? Well, for example, if the total credit you have available to you is $1,000, you shouldn't use more than 30% of that thousand, which equals $300 of that credit limit. So yeah, if you get a credit card and they give you a credit limit of $1,000, you should have it in your head that you shouldn't want to use more than 300. Now, of course, the credit limit is $1,000. So if you have an emergency and you need to use more than 300, then yeah, I mean it's an emergency. So yeah, that's what the credit card is for. But to maintain an optimal credit utilization percentage, you want to keep your utilization 30% and under if your objective is to keep a good credit score. Uh, a lot of those people with the higher credit scores of, like, the over 750s into 800s and up to the 850s, they normally have credit utilization percentages of, like 10% or maybe even lower, or maybe no balance at all. Uh, Carrying a balance is okay if you can keep it uh, under that percentage of 30% when if your utilization is great. I mean, you're going to pay interest on your balance every month, but I mean, that's up to you. You know, you want to pay off your balance every month and you don't pay any interest on any balance every month. I mean, that's great. Of course, it's going to be great. You have zero uh, dollars on your balance, zero utilization percentage. That's great. But if you're going to carry a balance, just try to keep it under 30%, just to keep your credit score looking good. See, the problem is, sometimes people, they have their credit cards and they tend to use up all the credit that's available. You have to be responsible. Like the example says, if you have $1,000, you don't want to just see, wow, I have $1,000 to use. No, don't think like that. Get into the habit of saying to yourself, okay, I have, such and such amount. For this example, I have $1,000 on my credit card. I don't want to use over 300. I don't want to use more than 250. Get into that habit, and I promise you, it will reflect in your credit score. Now, 15% of your credit score is determined by the length of your credit history, the age of your credit, how long you've had credit. Now, this doesn't account for as much of your credit score as your history and your credit utilization, but uh, FICO looks at this too. How long you've had your credit. People who, older people who've had credit for a long amount of time, and if they've been able to maintain, good credit scores, they're likely to be rewarded a little more because I guess maybe, FICO and the lenders, after they see you've had credit for a long amount of time and have been able to just have a maintain a good score, it accounts for a lot. I can understand that if you're able to have good credit with lenders for 10 years, 20 years, and you've been able to stay in good standing all that time. I mean, you're a very low credit risk. You're looked at as a much lower credit risk as opposed to someone who's only had credit for a year or two, and even though they have credit in good standing, I mean, you know, if someone has credit for 10 years, 20 years, and then they kept their credit good for all that time, they should have no problem getting a loan or a mortgage or whatever they want. 10% of your credit score is determined by the new credit accounts you open. Every time you apply for something and the lender or creditor has to pull your credit, you get what's called a hard inquiry on your credit report. Now, you say inquiry, whatever, the same thing. I say inquiry, whatever. But too many of those will lower your credit score. Uh, yeah, FICO accounts for every time you try to open a new credit account. Whether it be a credit card or a loan or anything that requires someone to run your credit. Like when you get a car, you sit there and they try to figure out which bank is going to give you the loan to get your car. When they run your credit, they're putting a ding on your credit report. That's what you call a hard inquiry. Now, uh, what makes up these hard inquiries are, like I said, when you apply for credit cards, loans, mortgages, and even utilities that you want to turn on for your home or your apartment. Like when I tried to turn on the cable in my house and I spoke to the customer service rep, I specifically asked him if this is going to put a hard inquiry on my report, on my credit report, and he told me no. But lo and behold, I check my credit report after I get my cable turned on. I see the credit company's name listed right there in my credit report because they definitely gave me a hard inquiry. So they gave me what they call a hard pull instead of a soft pull. A soft pull in your credit is when someone looks at your credit, but it doesn't count on your credit report. So I asked, is this going to be a soft pull? And he basically told me, yeah. And like I said, looked at my credit report, and there it was. And hard inquiries stay in your credit report for 2 years. I mean, they're not that much of a negative on your report. They probably uh, take about 2 or 3 points off, but every point counts. Another 10% of your credit score is determined by the types of credit you have in your report, called your credit mix. You should have different types of accounts like a couple of credit cards, car loans, mortgages, maybe even student loans, or anything else. Here's an example on how your credit mix can affect your credit score. If you go and try to get a car, your credit score is going to take a slight hit because they run your credit and you get a hard inquiry, but also because of that certain type of loan. On the other hand, if you go out and get a house and get a mortgage, you're going to take a hit, of course, because of the inquiry, but your credit profile will look a little better because it's a real estate account. What you want is a mix of both. You want to have, some consumer accounts, you know, uh, but I guess the car is considered a liability and the house is considered an asset. So I guess FICO looks at it, looks at both purchases a little differently. But you still want to have a mix of different accounts. You want to have your car payments, you want to have your mortgages, you want to have installment loans, you want to have 1, 2, or 3 credit cards. But at the end of the day, whatever you have on your credit report, as long as you pay everything on time, it's all good. Well, this is it. I'm glad you made it with me to the end. I tried to make good on my promise on keeping the video short, between 10 and 15 minutes. I hope I could provide some valuable info. I hope I gave you some info you could use. Please don't forget to comment, like, and subscribe. And definitely don't forget to go to my website, nomorepoorcreditscore.com. Until my next video, see you later. Take it easy. Thanks for watching.